Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into UiPath Inc., ticker symbol PATH, examining their recent Q2 FY2026 financial reports and, well, the seismic shifts currently reshaping their core business model. We've compiled a deep stack of recent analyses, quarterly statements, and technical research to understand exactly where this company is headed.
And if we look across all these sources, the central conflict for investors is crystal clear. The strong evidence points to UiPath successfully executing a pivot to becoming a market-leading agentic AI orchestration platform. Yet despite this leadership position and robust financial execution, the stock is currently trading at an incredibly cheap 4.9x forward revenue multiple, betting that meaningful new FY2027 revenue streams will ultimately justify the severe valuation discount we see today.
That is the ultimate question we need to resolve for you. We have a company that was historically defined by deterministic software, by robots doing the same thing every single time, suddenly jumping headfirst into the chaotic, probabilistic world of generative AI. How do they manage that transition? And maybe more importantly, does the balance sheet support the story? Let's start with that fundamental shift, the strategic pivot that management is calling their second act. It sounds dramatic, but why was this shift, moving beyond traditional robotic process automation, so absolutely essential for their survival?
Well, it wasn't just essential, it was, you could argue, existential. UiPath was the quintessential leader in robotic process automation, or RPA. But let's be honest, RPA, by definition, it's a deterministic field. The robot follows predictable, structured steps. Think of it as, a highly meticulous accountant doing data entry. It's effective, sure, but rigid. When generative AI arrived, capable of non-deterministic, probabilistic outputs of reasoning and generating content, the market immediately started asking, is traditional RPA, and by extension are the RPA vendors, destined to become has-beens?
And the size of the original RPA pond limited them, right? That simple, deterministic automation market, it just had a ceiling on its potential growth.
Precisely. The total addressable market for traditional RPA was estimated around, $25 billion globally? That's a significant market, don't get me wrong, but it is not a growth area that commands high software multiples anymore. By pivoting and strategically integrating these new generative and agentic solutions, where the AI agent can autonomously handle exceptions and knowledge, UiPath is effectively expanding their TAM into the much larger, potentially multi-trillion-dollar market associated with true enterprise AI adoption.
A multi-trillion-dollar market. That's the difference between automating data entry and automating, the cognitive processes of an entire knowledge worker. That's the ambition. But ambition is cheap. Execution is hard. They're asking investors to make a huge narrative leap, so we need proof that the operational execution is actually following the vision. Let's dissect the financials coming out of Q2 FY 2026. What hard numbers tell us this strategic pivot is being executed well on the ground, specifically around customer stickiness and growth?
Yeah, the top-line results provide very strong evidence of execution and operational rigor, which is honestly why the valuation mismatch is so perplexing. Total revenue hit $362 million for the quarter ended July 31st, 2025. What truly stands out is the growth rate, 14% year over year. That handily beat Wall Street's consensus estimate of around 10% growth.
Wow.
A 4-point margin beat is substantial in any environment, but especially for a major software player undergoing, a material business model transition.
So where did that outperformance come from? Was it new customers flashing the cash, or were there existing clients just spending more?
It was almost entirely subscription-led growth, which, as you know, is the gold standard for a resilient SaaS company. Subscription services revenue grew a very healthy 22% to $238.4 million. This indicates a robust and recurring revenue stream, reflecting healthy expansion from prior sales and the initial adoption of new solutions. In contrast, licenses revenue, those one-time payments, remained virtually flat, or actually saw a slight decrease over the last 6 months. That's related in part to the company's transition toward their flexible, subscription-based offerings. The shift really confirms the ratable, sticky nature of the revenue mix is improving.
Okay, so if subscriptions are up that significantly, it means their existing customers are deeply embedded in the ecosystem and are likely spending more over time. How did the annualized metrics, specifically ARR, reflect that customer strength and retention?
They look robust, definitely providing the backbone for the investment thesis here. Annualized renewal run rate, or AR, reached $1.723 billion. That's marking an 11% year-over-year increase. Now, here is the crucial internal metric supporting the pivot narrative. Approximately 74% of that ARR growth was attributed to existing customers. Only about 26% came from new logos or net new
All right,
customers.
74% from existing clients. That's a big number. It points to serious upselling.
It does. It shows they're successfully expanding their footprint within the companies that already trust them.
Well, let me press on that DBNRR for a moment. The dollar-based net retention rate, DBNR, stabilized at 108%. Now, 108% is durable. Yes, it's solid. But in a high-growth SaaS company that is selling a paradigm-shifting product like Agentic AI, shouldn't we maybe be seeing 120% or even higher, reflecting massive upsell of these new agentic tools? Does this 108% stabilization signal that the current install base is upgrading slower than hoped, or are they still primarily just buying more legacy RPA licenses?
That is the critical question. And yeah, it's the slight bearish counterpoint to the overall strong financials. The 108% DBNRR underscores the durability of the customer base. They are definitely not leaving. But it suggests the material monetization of the new agentic products, which, remember, we established is really scheduled for FY2027. Well, it hasn't yet fully hit the bottom line. It implies that the 74% of ARR growth from existing customers is currently driven more by selling additional traditional automation capacity and maybe initial, smaller agentic pilots rather than massive fleet-wide upgrades to the new AI architecture. The market is definitely waiting for that 108% to start climbing towards, say, 115%, 120% as the agentic revenue really ramps up.
Understood. So the foundation is solid, the customers aren't going anywhere, but that big growth acceleration hasn't fully materialized in the retention numbers just yet. However, the existing clients are demonstrating deep financial commitment by expanding their overall footprint. Let's look at the customer cohort strength, the big whales, the ones that really drive the enterprise valuation.
Yeah, that cohort data is certainly accelerating. Customers spending $1 million or more in ARR increased significantly to 320. That's up from 293 in the same period last year.
So 27 new seven-figure accounts in a year. Not bad.
Not bad at all. And meanwhile, customers spending $100,000 or more increased to 2,432. This shows significant expansion across both their largest and their sort of next-tier accounts. This expansion confirms the existing client base sees enough value to deepen their investment significantly, which, lays the groundwork for future AI platform adoption.
Okay, so we've established disciplined customer growth, but the overarching narrative of this quarter, I think, has to be efficiency and operating leverage. Looking beyond the revenue, the profitability story is genuinely striking, particularly the margin expansion.
That's probably the most impressive operational achievement here, signaling a deeply disciplined management team. Non-GAAP operating income reached $62 million, achieving a robust 17% margin for the quarter.
A 17% margin. Wow. In a challenging macro environment where many growth companies are still burning cash, that's extraordinary. What does that efficiency represent year over year?
It represents a massive 1,500 basis point year-over-year improvement in the non-GAAP operating income margin. That level of efficiency gain is driven largely by really disciplined expense management, especially following the completed fiscal year 2025 workforce restructuring. They weren't just, cutting staff randomly. They were clearly streamlining processes and focusing resources effectively.
But let's look at the trade-off maybe inherent in that rapid efficiency gain. Since operating expenses were reduced by 6% from the prior year, and sales and marketing specifically saw a steep 14% reduction, is there a risk they're trading short-term margin growth for long-term customer acquisition, especially in a competitive environment where they desperately need to land new logos in this agentic space?
That is the skepticism you absolutely have to apply to margin expansion, driven by deep expense cuts. The sources suggest that management believes they have simply optimized their spending, leveraging more efficient channels and focusing marketing spend on high ROI areas, like naturally their existing large customer base. The reduction in sales and marketing was primarily due to lower personnel-related expenses following that restructuring, so maybe it's just right-sizing. However, the risk is real. Cutting S&M by 14% while still needing to aggressively penetrate a brand new multi-trillion-dollar AI market might prove too conservative in the long run. They are essentially betting that the strength of the product and their partnerships will reduce the need for those expensive traditional sales efforts. It's a bet.
So they streamlined the organization, cut operational fat, and are now seeing the operating leverage kick in, all while still heavily funding the R&D required to build this whole agentic platform. This financial confidence has led management to signal a significant future change regarding deferred tax assets DTA. This is often a key signal of anticipated GAAP profitability, right? A milestone many software companies strive for. What exactly does this DTA reversal mean for the listener?
It's a huge vote of confidence from their own accountants, essentially. Deferred tax assets are basically future tax savings the company holds due to past losses. Normally, a company places a full valuation allowance against these DTA if they aren't confident they will generate enough taxable income in the future to actually use them. By signaling a reversal of that allowance, management is telling the market that they are now confident enough in their future earnings trajectory, their ability to generate sustained GAAP taxable income, that they can recognize these assets on the balance sheet. This doesn't mean new cash is suddenly appearing, but it means their accounting confidence in future cash flow and profitability is extremely high.
And what's the timeline they're suggesting for that reversal?
They are targeting a potential reversal of the full valuation allowance on the U.S. deferred tax assets within the next 6 months, so quite soon. And for the remaining DTA, they anticipate a reversal within the next 18 months. Releasing these allowances is a massive, tangible signal that they foresee sustained profitability in the very near future.
Okay, the financials show a clean, well-executed operational quarter, driven by internal customer expansion and significant efficiency gains. But as you noted, the valuation remains stubbornly cheap. That suggests the market is not yet convinced the underlying technology is a durable differentiator, especially against hyperscalers like Microsoft. So let's trace that R&D investment directly to the product architecture and the technology moat they're building around this core concept of controlled agency.
Right. The core philosophy guiding their technology is this: automation and AI are profoundly stronger together. The platform is explicitly designed to unify AI agents, which are probabilistic traditional deterministic robots, and, importantly, human decision makers on a single integrated intelligence system. This unified approach, that's their moat.
Let's delve deeper into that synergy. We mentioned earlier the critical difference between deterministic and probabilistic outputs. Use a real-world scenario to make this concrete for the listener. How does this actually work?
Certainly. Think of it this way. Traditional RPA is like that meticulous accountant. If you ask it to process a simple three-way invoice match, assuming the data is clean, it succeeds 100% of the time. That's deterministic. If the process is fixed, the robot is flawless. Now, imagine a more complex scenario, say a customer service agent handling an emotional complaint involving a partial refund and a complex warranty claim.
Okay, yeah, that's messy. The complaint isn't standard, and the solution requires reasoning and perhaps searching through vast amounts of unstructured data, like emails or call transcripts.
Exactly. That is where agentic AI, which is probabilistic and non-deterministic, excels. It can conduct the research, summarize the complex warranty documents, maybe understand the customer sentiment, and reason conceptually to suggest the best solution. However, and this is the crucial point, you absolutely cannot allow the probabilistic agent to perform the deterministic final step, like updating the CRM database or actually processing the refund, without error checking and adherence to strict process rules. The key differentiator for UiPath is successfully marrying these two approaches. They use the agent for the messy upfront research and exception handling, and then they rely on the deterministic RPA robot for the last mile of execution, ensuring accuracy and compliance.
So it's not really AI replacing RPA, but more like AI giving RPA a much higher cognitive ability,
Yeah.
allowing it to handle complexity it never could before. How is this complex hybrid system managed? We need a brain, right? A core orchestration backbone that tells the agents and robots what to do and when to do it, and maybe when to involve a human.
That brain is called Maestro. Maestro is the core orchestration layer that unifies these complex multi-stage workflows. Its function is to coordinate all assets: AI agents, deterministic RPA robots, API workflows, and crucially, human decision makers across end-to-end business processes. Maestro is what breaks down the silos, ensuring that the human isn't waiting on the robot and the robot isn't waiting on some third-party AI model to respond. It keeps the whole process flowing.
And we're seeing metrics that show Maestro is being used extensively, even in this early phase. People are actually using this coordination layer.
We are. In Q2 FY2026, Maestro orchestrated over 170,000 process instances. That's not a small pilot program. That's a significant early signal that customers are actively leveraging the platform's capacity to dynamically mix and match these digital workers, switching between probabilistic reasoning and deterministic execution seamlessly.
Okay, now let's get to what feels like the true moat. The thing that enterprises, especially in regulated sectors like finance or healthcare, will absolutely pay a premium for: controlled agency. That sounds like the key to solving the hallucination problem, the liability problem, really inherent in corporate AI deployment.
It really is the foundation for enterprise adoption and why the hyperscalers haven't just immediately wiped them out. Controlled agency is all about providing ironclad guardrails and compliance for non-deterministic AI outputs. Enterprises simply cannot apply probabilistic AI to mission-critical processes. Think HIPAA-protected health records, SOX-compliant financial data, or highly sensitive internal emails, without ironclad auditability and governance baked in. Without that control, they expose themselves to massive legal liability. It's a non-starter.
And the sources show a striking consensus on this governance necessity from the actual practitioners, the tech leaders on the ground.
Absolutely. External data shows that 76% of tech leaders surveyed said governance was extremely important in their deployment of new AI tools. They are eager to innovate, obviously, to save millions through AI, but they must do so responsibly. UiPath's advantage here is that they already have a pre-existing centralized control plane built over years to manage thousands of traditional robots globally. This existing infrastructure translates relatively easily into managing non-deterministic agents with compliance baked in from day one.
And what do these guardrails look like in practice? Give us a tangible example of how Maestro prevents an agent from making a costly or non-compliant mistake in a real business process.
So, the platform enforces policy directly within the orchestration layer. For instance, in a financial approval process, you can set a hard, non-negotiable rule that an AI agent can never approve a payment over $100,000, regardless of what data it reasons upon or how confident it feels. If the payment exceeds that threshold, Maestro automatically routes the transaction to a specific human manager for two-factor approval. Simple as that. Another crucial mechanism is provisional autonomy. For a specific brand new process, the agent might require human review on 100% of its outputs initially. Then, only once system data proves the agent's accuracy threshold is consistently met, say 98% accuracy over thousands of runs, can its autonomy level be gradually dialed up by an administrator. This ability to dial up or dial down the autonomy and to trace and audit every single decision the agent makes, that's what gives large regulated enterprises the confidence to actually deploy AI at scale.
That transparency and traceability, yeah, that seems essential for bridging the gap between innovative AI capabilities and conservative corporate risk tolerance. What other specialized technology is UiPath leaning on to solidify this moat and handle the huge amounts of unstructured data companies are drowning in?
Two other key technologies really differentiate them beyond Maestro. First, we have Intelligent Extraction Processing, or IXP. This innovation is crucial for handling complex, highly unstructured content. Things like handwritten documents, skewed scans, messy customer email threads, even faxes sometimes. Historically, pulling structured data accurately from these complex documents was a massive, expensive bottleneck that often halted automation projects entirely.
Right, so the agent might be brilliant at reasoning, but if it can't correctly ingest the data from the document in the first place, the whole process fails right at the start.
Exactly. Garbage in, garbage out, even for AI. UiPath integrates IXP to intelligently extract and, critically, understand this unstructured data, which then feeds the agent's accurate contextual information. We have this staggering example from the earnings call of one customer processing 20 million pages of documents and achieving a 35% reduction in errors simply by implementing IXP. That is immediate, tangible ROI that prevents costly downstream mistakes.
A 35% error reduction on 20 million pages.
That's huge.
Okay, and the second key differentiator beyond IXP.
The second is the UiPath Data Fabric. AI agents, as we know, are only as good as the context they have access to. If an agent has to manually pull data from 10 different systems, your SAP, your Snowflake, Salesforce, plus thousands of internal documents scattered everywhere. It's slow, it's often inaccurate, and it creates massive security risks by replicating sensitive data all over the place. The data fabric aims to solve this. It provides agents with zero-copy access to trusted, context-rich data, whether that data is structured coming from systems like SAP or Snowflake, or unstructured documents and communications. This context-rich grounding ensures more accurate execution by the agents, minimizes those costly hallucinations we hear about, and allows the platform to function without needing huge, complex data integration projects up front.
And the market seems to be responding to this overall architecture. We are seeing real-world adoption metrics quickly ramping up following the platform launch back in May, correct?
Yes, the agentic traction metrics since the launch are extremely encouraging. Customers have executed almost 1 million agent runs in just a few months. That shows usage. But perhaps the most important metric for future growth is that over 450 customers are actively developing agents with the clear intention of deployment. These are the folks in the pipeline who will drive that crucial FY2027 revenue. This suggests the pivot isn't just, a marketing concept slide. It's gaining rapid commercial traction with actual customers building real solutions.
The technology certainly seems to be the right tool at the right time, providing that necessary governance layer for enterprise AI. But in the age of massive platform players, no single company operates in a vacuum. Let's shift our focus now to the market strategy. How is UiPath using strategic partnerships to drive adoption and ensure its technology remains relevant, especially with giants like Microsoft also playing in this space?
Well, UiPath has positioned itself brilliantly, I think, as the elusive bridge that connects the massive ongoing AI infrastructure spending, all those billions, being poured into GPUs and foundational models by companies like Nvidia, Google, and Microsoft, directly to tangible, measurable return on investment for the enterprise. We've established that enterprises are spending money on AI infrastructure, but they need a mechanism to actually use that intelligence to save money, streamline operations, or make better decisions in a controlled way. UiPath, through Maestro and its platform, is positioning itself as that crucial mechanism.
And a crucial part of that pitch, especially when working with potential rivals like Microsoft, is vendor agnosticism, right? Not locking customers in.
It is their strategic shield against vendor lock-in, which, let's face it, every CTO fears. UiPath's pitch is based on being an agnostic player. They allow customers to deploy the best models and open source frameworks for the specific job, whether that's a large language model from Google, a specialized microservice from Nvidia running on NIM, or maybe an open source model running on premise. Crucially, they even support popular open source orchestration frameworks like LangChain and Llama Index within their platform. This flexibility gives customers the confidence that they can scale their automation across an open, secure ecosystem without being forcibly locked into a single AI provider's stack down the road.
Let's talk specifics on the high-profile alliances they have leveraged recently, starting with the most, let's say, interesting one, Microsoft. This is where competition seems to be turning into collaboration, at least publicly.
Yeah, the strengthened alliance with Microsoft is fascinating because it really reframes the competitive landscape. While Microsoft obviously has its own Power Automate platform, they have publicly recognized UiPath as a preferred enterprise agentic automation platform running on Azure. This goes far beyond just a simple reseller agreement. UiPath has a bidirectional connector for Microsoft's Copilot Studio, meaning their platforms can actually talk to each other seamlessly. And Maestro is explicitly used to orchestrate complex end-to-end workflows involving Azure AI Foundry agents, which are Microsoft's own AI components.
Can you give us a clear, maybe high-stakes example of that Microsoft orchestration in action, perhaps in a regulated industry where this really matters?
A key use case they highlighted is in healthcare, specifically managing incidental findings in radiology reports. So the Azure AI Foundry agents might be used to process the medical images and summarize the technical findings. That's the probabilistic reasoning part. But UiPath's platform then orchestrates the complex workflow around that AI finding, summarizing the AI output concisely, immediately integrating it with the patient's electronic medical records via the data fabric, creating a structured task in a system like Epic, and then routing the final verified information to the appropriate care provider for human review and action, all while adhering strictly to IPAC compliance guardrails managed by Maestro. It ensures that the AI insight leads to a compliant, completed action, not just an isolated piece of data.
Okay, that makes sense. And they are also deeply integrated into the raw AI infrastructure layer itself, notably with Nvidia, the company providing a lot of the underlying compute power.
Yes. The partnership with NVIDIA, is critical because it addresses the technical deployment headache for enterprise IT teams. It involves integrating UiPath automation with NVIDIA's Nematron models and InM, which stands for NVIDIA Inference Microservices. For the listener, NI is important because it basically simplifies the process of getting complex AI models deployed and running quickly and efficiently in an enterprise environment. UiPath leverages this to allow enterprises to deploy ready-to-use AI microservices for complex tasks like natural language processing or predictive analytics, all orchestrated and governed through the secure UiPath platform. It means the powerful NVIDIA silicon can be operationalized almost instantly for actual business users, not just data scientists.
And beyond the cloud giants and the chip makers, they're also ensuring plug-and-play connectivity to the critical data and application platforms that every major enterprise relies on day to day.
Absolutely. They have strategic collaborations with Google Cloud, GOGL, including working together to develop specific verticalized solutions like that medical record summarization agent tuned for Google's healthcare AI expertise. And just as importantly, they ensure immediate friction-free connectivity with major enterprise data repositories and applications like Snowflake, SNOW, SUP, and Salesforce. This pervasive connectivity minimizes implementation friction and speeds up time to value, which is absolutely essential for overcoming that FY2027 timing risk we discussed earlier. They need customers deploying quickly.
So how is all this technological integration and partnership strategy translating into immediate commercial momentum, beyond just the sheer number of agent runs we discussed earlier? Is it truly hitting the deal flow now?
Management, specifically CEO Daniel Dines on the earnings call, stated quite emphatically that the new AI and agentic solutions are accelerating deal sizes and increasing commercial momentum overall. He noted that these solutions are helping UiPath win deals faster than traditional, often lengthy and complex automation engagements. The complexity and the higher value proposition of agentic orchestration apparently allowed them to get to a large contract size more quickly with sophisticated buyers.
Do we have specific material examples of this immediate revenue impact? Any big wins they talked about?
We do. Management cited securing a massive seven-figure deal with a Fortune 15 global technology company that immediately leveraged the newly launched agentic products. This shows that the largest, most sophisticated companies are willing to pay significant sums right now for this controlled agency capability. There was also the notable expansion with Voya Financial, demonstrating that the pivot is generating significant new revenue opportunities within the existing customer base, confirming the strategy of upselling into that 74% ARR internal growth component.
And finally, let's address their relationship with global system integrators, or GSIs, the Deloittes, Accentures, PwCs of the world. Historically, that partnership strategy has sometimes been critiqued as being maybe a bit too passive.
Yeah, the focus on GSIs seems to be undergoing a crucial renewal. Management has always relied on SIs as a channel, a vehicle for large transformation projects. Now, as these major SIs are making strategic multi-year bets on which orchestration platforms to build their own AI services and practices upon, UiPath is apparently being seen as a major preferred option. For GSI, choosing UiPath means they can offer their enterprise clients the governance and control necessary to move beyond just AI pilots and into massive, regulated AI deployments with confidence. This reinforces UiPath's position at the critical center of enterprise transformation, leveraging the reach of these huge consulting firms.
Okay, the bullish case seems fully built now. Strong, efficient financials with that massive 1,500 basis point margin improvement, a powerful governance-focused technology moat built around Maestro and controlled agency, and high-profile strategic partnerships that help operationalize all the AI infrastructure spending. But no investment thesis is complete without a deep, critical look at the risk factors. As we move to the final section, we really need to balance this immense optimism against the competition, the legal contingencies, and crucially that timing risk inherent in the agentic pivot.
That balance is absolutely paramount, especially when we remember that the current valuation of 4.9x forward revenue seems to already bake in a profound degree of investor skepticism. We need to understand precisely why the market is applying such a harsh discount to what appears to be a technically and operationally successful company.
Let's start with the most obvious factor, competition. Who is UiPath really fighting right now, and what is their durable defense against them? It can't just be Maestro, can it?
Well, the competition is fierce, no doubt, and it's diverse. It's coming from pretty much every direction simultaneously. On one side, you have the large, diversified platform players like Microsoft Power Automate and ServiceNow. Both are leveraging their vast existing install bases, their own significant AI initiatives, and of course the power of bundling their automation tools with other essential enterprise software. Microsoft can always offer its tools cheaper because the real profit is often made on the underlying Azure cloud consumption. Then on the other side, you have specialized smaller firms focusing narrowly on specific AI agent tasks, perhaps moving faster on the absolute cutting edge in certain niches.
So how does UiPath defend its position against a colossal competitor like Microsoft that can simply bundle AI tools into its massive cloud ecosystem, potentially undercutting them on price?
UiPath's main competitive advantage really does remain, as we've thoroughly established, its dedicated focus on governance and that centralized control plane, Maestro. For large global enterprises, particularly in highly regulated sectors like banking, insurance, healthcare, the guarantee of compliance, auditability, and controlled agency is simply non-negotiable. Microsoft may offer cheap tools, but UiPath offers enterprise-grade certainty and control over those tools and potentially over Microsoft's own tools via orchestration. The enterprise knows that when a human absolutely needs to review an agent's work before it hits production, Maestro will flag it, document it, and enforce the business rule. That level of granular control is something the hyperscalers are often less focused on than raw model performance or broad platform features.
Okay, that makes sense. Now let's address what analysts seem to view as the most pressing and material risk to the near-term stock multiple, the timing mismatch. That directly relates back to that 108% DBNRR we discussed earlier, doesn't it?
It does, and this is arguably the most critical risk because it directly impacts the stock's short-term viability and likely explains a large part of the current valuation discount. The timing mismatch is simply the gap between the rapid hype and clear customer adoption, all those 450 customers actively developing agents, and the material monetization, the actual revenue hitting the books from those solutions that investors are demanding now.
What exactly has management guided for in terms of revenue contribution from agentic AI this current fiscal year, FY 2026? Are they expecting big numbers soon?
No, quite the opposite. Management has been very cautious and transparent about this, which is good governance practice, but maybe bad for short-term stock price momentum. They stated explicitly on the call that fiscal year 2026 is merely a foundational year for agentic automation, and they do not expect a material top-line contribution from these new products this fiscal year. That means the hundreds of millions of dollars in potential AI deals aren't expected to fully hit the P&L until next year, FY 2027.
So if the entire growth thesis relies on this agentic AI pivot, expanding their TAM and re-accelerating growth, the material monetization is explicitly pushed out, creating basically a year-long waiting period for investors. What are the dangers of that waiting period?
The danger is multifaceted, really. First, investor patience is notoriously thin in today's market. If the transition takes longer than anticipated, or if the macroeconomic environment forces slower enterprise IT spending in the interim, the risk of short-term investor disappointment and further multiple compression is immense. People might just give up and sell. Second, a year is an eternity in the AI space right now. While UiPath clearly has a strong head start on enterprise-grade governance, this waiting period gives aggressive competitors like Microsoft and ServiceNow valuable time to catch up and build out their own robust governance layers, potentially commoditizing UiPath's controlled agency moat before UiPath fully monetizes it. The clock is definitely ticking until FY 2027.
Okay, so timing is risk number one. Beyond execution and timing, the company is also dealing with several legal and regulatory contingencies that, while perhaps not material enough individually to derail the entire company, certainly add a distinct layer of financial and operational uncertainty. Let's quickly detail the securities litigation they are managing.
Right, that's risk number two, legal and regulatory contingencies. They are currently managing two active securities. Litigation matters that, at a minimum, require significant management time and legal resources, distracting from the core business.
Let's detail the first one, the 2023 securities action. What was that about?
The 2023 action concerns allegations of misstatements made back between 2021 and 2022 regarding UiPath's competitive position and financial results, primarily in the traditional RPA space before the big pivot. While the court dismissed a large portion of the claims, which is good, it importantly allowed the case to proceed with respect to two specific statements relating to competition under the Exchange Act. This means the company is actively defending specific claims about past representations regarding their competitive environment. And relatedly, a new shareholder derivative lawsuit has also been filed based on these core claims, which requires a separate defense effort.
Okay, and the 2024 securities action, which was filed more recently, focused on the pivot itself.
Yes, exactly. The 2024 action focused specifically on the company's newer AI platform strategy and the early success, or alleged lack thereof, of its new offerings. The court granted UiPath's motion to dismiss the amended complaint, which was definitely a positive development. However, critically, it allowed the plaintiffs until September 12, 2025, to file a second amended complaint. So while it's dismissed for now, the risk remains active and requires constant vigilance, keeping the threat of potentially costly discovery and trials hanging over the company.
And outside the U.S., they're grappling with significant tax risks, particularly concerning their large Romanian subsidiary, which has direct potential financial consequences, right?
Yes, this is a notable near-term financial contingency. The company is currently appealing a $14.3 million value-added tax, or VAT, assessment in Romania for the 2020-2022 period. Importantly, this is an amount they have already paid out, so it represents a cash outflow that they are trying to recover. Furthermore, a separate ongoing VAT audit for the period from February 2022 through February 2024 is currently suspended pending the outcome of that first appeal, but carries an estimated possible loss of approximately $13.0 million. So if they lose the appeal and the subsequent audit also goes against them, they are potentially looking at close to $27 million in contingent liabilities and associated cash outflows, which is a pretty substantial non-operational cost for a company their size.
Okay, $27 million potential hit. Got it. Now, the third critical risk relates purely to corporate governance and optics, specifically the broad-based insider selling reported recently, which inevitably casts a shadow of skepticism over the leadership's conviction in the near-term share price appreciation.
Yeah, this is perhaps the most difficult risk to swallow from an investor sentiment perspective, even if it's technically above board. Both CEO Daniel Dines and CFO Ashim Gupta adopted Rule 10b5-1 trading plans back in July 2025. These plans allow them to sell large quantities of their Class A common stock systematically through April 2026.
And we know what 10b5-1 plans are. They're pre-scheduled plans that allow insiders to sell shares systematically over time without being accused of trading on non-public information. So why are analysts viewing this specific instance of selling as problematic? It's pre-scheduled, right?
Analysts are mainly concerned with the sheer scale of the selling and, crucially, the timing. While the plans are automatic once set up, this broad-based insider selling by both the CEO and CFO simultaneously is viewed as a significant governance concern right now. The timing is particularly poor because it comes immediately after management has publicly declared this transformative second act, highlighting the incredible technological inflection point and the potential for that multi-trillion-dollar market expansion. Analysts covering the stock explicitly noted that this level of selling does not echo conviction shared by management, at the very moment when the business is reportedly inflecting positively. It just introduces profound skepticism about management's own belief in the company's near-term share price potential, making it that much harder to convince skeptical external investors that the current 4.9x multiple is fundamentally wrong.
Okay, so we have the immense operational momentum, that 1,500 basis point margin improvement, and the clear path towards agentic monetization balanced against these serious timing risks, legal headwinds, and frankly, poor governance optics from the selling. Let's bring this all back now to the final valuation verdict. Where does this leave us?
Well, the operational efficiency and the long-term targets are undeniably impressive. Management is guiding for a non-GAAP gross margin of approximately 85% for the full year. That is world-class for any software company. And they are actively positioning the company to achieve GAAP profitability in the very near term, as signaled by that potential DTA reversal. They have clearly built an incredibly efficient, high-quality underlying business.
Yet, despite this technological sophistication, the strategic pivot, and the stellar margin profile, the stock still trades at that profoundly conservative multiple.
Correct. Based on the raised full-year FY2026 revenue guidance of roughly $1.571 billion to $1.576 billion, the current valuation stands at that incredibly cheap 4.9x forward revenue multiple. This is well below what high-growth, high-margin, market-leading AI software companies typically command, suggesting the market is primarily focused on the competitive threats and, most importantly, that delayed monetization timeline.
So bringing all the source material together, what is the final conclusion for the listener trying to weigh the risk and reward here?
I think the strong operational execution, combined with what appears to be clear technological leadership in controlled agentic orchestration, means the current 4.9x valuation fundamentally undervalues the platform's long-term potential. The market seems to be failing to fully price in the expected success of the agentic pivot and the sustainability of those best-in-class 85% gross margins. However, and this is a big however, this bullish outlook is entirely conditional. The valuation discount will only close if and when the anticipated FY2027 revenue acceleration actually materializes, successfully bridging that gap between current adoption momentum and future monetization reality. It's really an investment that requires patience, basically waiting a full year for the core thesis to definitively play out, all against the backdrop of significant legal and governance noise in the interim.
It really sounds like UiPath has done the hard internal work of making the strategic pivot and cleaning up the balance sheet, getting operationally efficient. But the ultimate reward for shareholders is still potentially a year away. The core investment question remains: can the market afford to wait for that FY2027 payoff, or will it let the very real short-term risks derail the long-term potential before it arrives? Risk defined, portfolio protected.